In lectures this week, one of the topics that we're going to examine are the government's proposed changes to the funding of long-term care. One of the main planks to these proposed reforms is the introduction of a lifetime cap on contributions that individual service users would need to make towards the cost of their care. Now, one of the motivations for this cap is to try and help insurance markets to emerge. In this video, we're going to introduce the economics of insurance markets. Let's begin with a really simple model. In this model, you start off with an initial wealth of W1. Now, there are going to be two states of the world in this model. There's a bad state of the world, which occurs with probability P. In the bad state of the world, you experience some loss, and that reduces your overall wealth. So in the bad state of the world, you experience a loss, which reduces your wealth from W1 to W2. And this bad state of the world occurs with probability P. With probability 1 minus P, you don't experience the loss. So in the good state of the world, your final wealth is going to be W1. We're going to make the assumption that you are a risk-averse individual, your utility is based on your final wealth, and your utility is increasing in terms of your wealth. So U of W1 is greater than U of W2. Now, what we want to try and show is that a risk-averse individual would prefer to purchase an actuarially fair insurance contract so that they can consume the same amount in both the good and the bad state of the world over any other possible combination. So, how do we go about doing this? Let's start by trying to represent the problem diagrammatically. So, we've got two states of the world. We've got a good state of the world and a bad state of the world. The good state of the world occurs with probability 1 minus P. The bad state of the world occurs with probability P. And you start off with an initial endowment, effectively. This is representing your wealth in the two states of the world. So in the good state of the world, you end up with a wealth of W1. And in the bad state of the world, where you experience your loss, you end up with a wealth W2. So let's tidy that up. Now, we want to try and think about insurance contracts, because insurance contracts allow you to effectively sacrifice some of your wealth in the good state of the world by buying an insurance contract, by paying an insurance premium, in order to allow you to increase your wealth in the bad state of the world. The way that insurance markets work is that lots of people buy these insurance contracts and they pool their risk together. They pool together their premiums, and if you suffer a loss, you then receive a payoff in that bad state of the world. So, this 45-degree line that we've drawn here represents equal consumption. It represents consumption being the same in both the good state of the world and the bad state of the world. So, an insurance contract can allow us, through the pooling of risk, to equalize consumption in both the good and the bad state of the world. But the question is, what would that insurance contract look like? So, if we have an insurance policy, we're going to pay some premium, and let's call that premium Alpha 1. Alpha 1 is the amount that you pay in order to purchase insurance. And the impact of that Alpha 1 is to reduce your wealth in the good state of the world. So Alpha 1 is effectively something that is negative. It's a reduction in your wealth. Now, the impact of insurance, by pooling our risk with other individuals, an insurance contract allows us to increase our consumption in the bad state of the world. In this case, we're going to define that increase as Alpha 2. So the question is, what would the contract look like in order to allow us to equalize consumption across the good and the bad state of the world. Now, we've got two states of the world. In the good state of the world, effectively we're having a reduction of our wealth of alpha 1. In the bad state of the world, we're effectively increasing our wealth by alpha 2. So what would an actuarially fair contract look like? Well, an actuarially fair contract makes a number of assumptions. The first thing is that we're going to assume that insurance companies are perfectly competitive. They're competing against each other for insurees. So what that would mean is that they are making zero profits. The effective profits are going to be zero. So that means that the expected income from premiums needs to be equal to the expected payout in terms of alpha 2. So what we can say is that, let's treat this on an individual level. Since an individual pays out a premium alpha 1, the expected value related to the premium is they have a reduction of alpha 1 in the good state of the world, and the good state of the world occurs with probability 1 minus p, and that's balanced by the payout in the bad state of the world of receiving alpha 2, but then we weight that by the probability p. So what that can tell us is, if we were to think about a straight line joining the initial endowment point with equal consumption, that would tell us that alpha 1 over alpha 2, that's going to be the gradient of this slope, is going to be equal to minus p over 1 minus p. So if we've got an actuarially fair contract where the insurance company is making zero profit, it's going to have a slope equal to minus p over 1 minus p. Now, a thing to note is that individuals can buy either full insurance, that's where consumption is equal in the two states of the world, or partial insurance, which would be anywhere along this insurance contract line. So any of those red dots would represent partial insurance. It would be allowing the consumer to buy a contract to enable them to partially insure their risk. Now, what we really want to try and show is that this equal consumption point would be the optimal contract for a consumer. That would be the contract that a consumer wishes to purchase. Now, how are we going to show that? Let's think about this intuitively. Individuals have indifference curves which represent different levels of expected utility. We've got expected utility increasing in this direction. So we have the highest level of expected utility in this set of indifference curves would be here, and the lowest would be here. Now, the question is, at what level would an individual buy an insurance contract? What would give them their highest level of expected utility? So in other words, at what point would an indifference curve be tangential to the insurance contract line? The way that we've drawn these indifference curves makes it look like that's going to occur at full insurance. But how do we know that? Well, let's start by looking at the indifference curve when we've got zero insurance. When we've got zero insurance, we've got this indifference curve here. Now we can see straight away that we could improve our expected utility by moving to a higher indifference curve. With full insurance, we can access a higher indifference curve. We've been able to move to that higher level of expected utility. But we want to try and prove mathematically that the optimal contract, the optimal point along this insurance line, will be the point of full insurance. So we wish to show that a risk-averse individual will prefer buying full insurance over any other actuarially fair insurance contract, or even no insurance. Now, the way that we're going to try and do this is we're going to try and show that the highest feasible indifference curve is tangential to that insurance contract line at the point of full insurance. So in other words, the slope of that indifference curve is equal to the slope of the insurance contract line at that point of full insurance. Now, in order to model this, let's start by writing down some new definitions. And we're going to define your final wealth in the good state of the world as Z1. And we're going to define Z2 as your final wealth in the bad state of the world. Now we can write down the equation of our indifference curves as just equal to some constant level of expected utility is equal to the weighted average of our utilities based on our different wealths in different states of the world. So in the good state of the world, which occurs with probability 1 minus p, we end up with a final utility u of Z1. And in the bad state of the world, which occurs with probability p, we end up with a utility based on Z2. Now we want to find the slope of our indifference curve at the point where, at the highest feasible point. So in other words, we want to find dz1 by dz2. And we want to try and show that this is equal to the slope of the insurance contract line at the point of full insurance. So in order to find the slope of our indifference curve, we're going to need to effectively differentiate this expression. Now on the left-hand side, we've got a constant. An indifference curve is just a constant level of expected utility. So we could differentiate this left-hand side with relation to Z2, but that's just going to be equal to 0. Now let's differentiate our right-hand side with relation to Z2. So we're going to have 1 minus p times by the derivative of u prime of Z1. But because we're differentiating with relation to Z2, we need to multiply by dz1 by dz2, because we're effectively using the chain rule here to differentiate. Then the second term, we've got the derivative of p times by u of z2. That's going to be p times by u prime of z2, the derivative of z2, times by the derivative of z2 with relation to itself. Now this term is just going to be equal to 1, so we can rewrite this whole thing. Remember that dk by dz2 is just 0, is going to be equal to 1 minus p times by u prime of z1 times by dz1 by dz2 plus p times by u prime of z2. So we can rewrite this to give us that dz1 by dz2 is going to be equal to p times by u prime of z2 over 1 minus p times by u prime of z1. So let's tidy that up a little bit. Now, this actually tells us the slope of our indifference curve. And at the point of full insurance, Z1 is equal to Z2. So that means that U prime of Z1 is going to be equal to U prime of Z2. So at full insurance, this ratio is going to be equal to 1. So at the full insurance point, the slope of our indifference curve is just equal to minus p over 1 minus p. And similarly, the slope of the insurance line is minus p over 1 minus p. So that must mean that at full insurance, the indifference curve is tangential to that insurance contract line. The highest indifference curve that we can reach is the point that is tangential to that insurance contract line. A risk-averse individual would prefer to purchase full insurance over partial or no insurance.